Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I had a discussion with a YouTube viewer about what is the best way to get cash flow, that is, income and money from your investments. The viewer suggested selling a few shares here and there, while I, as a dividend investor, take a different approach, but I am aware there isn't an obvious answer. This debate has been raging in the financial independence circles for a long time. So let's bring this up to a higher level to compare and contrast dividend paying stocks and growth investing in Canada, and getting cash flow question will be answered. As I mentioned, I am a dividend investor, but I will cover both sides. As usual in finance, the answer is it depends, so I will be playing a little devil's advocate. Let's define value and growth investing. Value is investing in stocks that are inexpensive, usually on the price to earnings and price to book basis. Value stocks usually pay dividends where the company takes some of their profits and passes them on to the investor owner. Growth investing is buying stocks with high prices and a lot of expectations for the future. The company is hopefully going to grow its business and earnings to meet those high valuations. If the stock is expensive now, it will get more expensive as the company grows. Let's look at dividend paying stocks or value stocks. First, the pros. You get a stable income, so it provides a regular income through dividends, which can be reinvested or used as cash flow. It has lower volatility. Typically, it involves established companies with stable earnings, leading to less price volatility. There are tax advantages. Canadian dividends often receive a favorable tax treatment compared to interest income. For me, I get the dividends for the tax benefits in my non-registered accounts. Canadian eligible dividends until $120,000 per year, say, depending on the province, are taxed a lot less than capital gains. Around the 120K mark, or 150 in Alberta, capital gains become more tax efficient based on the marginal tax rate. But even at that point, the dividends have a much lower average tax rate, since the tax rate is negative in the lower tax brackets in some provinces like BC. I'm around 120K in dividend income now, and I am paying about 10K in taxes. So that's probably my main reason for going the dividend route. Next, value stocks are defensive in nature. Companies that pay dividends are often in sectors like utilities, banks, and consumer staples, which tend to be more resilient during economic downturns. Finally, there's a psychology. People don't like to dig into their principal psychologically. And what is worse, if the market goes down, a growth investor still has to sell a couple of shares that are down, so that feels even worse. Note that it does all work out the same because the dividends are not free and they are coming out of the company's net worth. So if the market is down, the dividend is similar to selling shares after a correction. But I don't need to feel bad for selling low since I don't control the dividend and it wasn't my decision. Similarly, in a down year, dividends coming in, again, psychologically, keep people invested, while if they needed the shares to go up, like a growth investor does, and the shares go down instead, they might panic and sell everything. Now let's take a look at some cons of value investing. So there is a limited growth potential. Dividend paying stocks may offer lower capital appreciation compared to growth stocks. As far as interest rate sensitivity, high dividend yields can be less attractive when interest rates rise, as investors may prefer interest-bearing assets instead. There is no control over dividends. As I said to the YouTube viewer, he's right. The dividends come whether I'm in a high tax bracket or not, whether I want them or not. There is much better control when you have the option to sell a few shares and you can make all those decisions. Dividends aren't free. As mentioned earlier, dividends come out of the net worth of the company, aren't free, and aren't conjured out of thin air, as some people think. So are dividends an indicator of good companies? People will argue that dividend payers, especially those that increase the dividend, are solid companies that can afford to pay the dividend. But looking at an increasing EPS, earnings per share statistic, would give the same idea of what companies are solid, and the company isn't forced to keep paying dividends to its owners when it could use the money much better to grow. Let's look at growth investing. Some pros. First, you have a high growth potential. It focuses on companies with strong growth prospects, which can lead to significant capital appreciation. Innovation. Often, growth companies are in sectors like technology, biotech, and renewable energy, which are at the front of innovation. Long-term returns. While more volatile, growth stocks can provide substantial returns over the long term. Value and growth take turns outperforming each other. Growth can outperform for decades, as it did with the low-interest 2008 to 2021 years. Profits are reinvested. Rather than paying dividends to the shareholders, the company reinvests its profits in the company. Arguably, if a company reinvests its profits, it should be able to do it better than paying the money to its owners and then the owner going to a pub with it. And if you trust the company with your money already, why not trust it to give you the best ROI with the profits too? Next, some cons of growth investing. You have higher volatility. Growth stocks can be more susceptible to market fluctuations and economic downturns. There is no regular income. Unlike the dividend stocks, growth stocks do not provide regular income, requiring investors to sell a few shares for cash flow, as we discussed. And you have overvaluation risk. High expectations can lead to overvaluation, making it difficult to achieve expected returns. People will buy the stock because they're expecting it to go up, not on fundamentals. And there are a lot of expectations and a lot of sentiment built into the stock price. In conclusion, the choice between dividend-paying stocks and growth investing depends on your financial goals, risk tolerance, and investment horizon. If you prefer steady income and lower risk, dividend-paying stocks might be more suitable. If you're willing to take on more risk for the potential of higher returns, growth investing can be the way to go. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.